Everyone's wondering when the housing market is gonna crash. As house prices, mortgage rates, and fears of a recession continue to climb, I notice there's something weird happening in the housing markets that no one is talking about. This thing has been in the shadows, shaping our cities and manipulating our markets for years, leading to the lowest home affordability since 1984. But first, to understand who or what is behind this, we need to understand how the perception of housing as a commodity revolutionized from just a few decades ago. Prior to the 1980s, at its core, housing was just a way to not die during cold winters, and maybe having a yard for playing with your dog. The early housing market was only seen as a place to live and not as an investment. House prices never rose fast enough to outpace wage growth or stock market returns. No one expected to lose money on a house, but people saw it as a way to store money rather than to multiply it. Over time, that view began to change. The 1980s saw the rise of real estate as an investment with the mortgage bond. In finance, a mortgage bond is like a basket holding people's mortgages, and that basket can be bought and sold, like a stock. This new type of investment eventually encouraged banks to freely lend money to anyone looking to buy a home, even if they seemed risky. Because the bank could just bundle these mortgages and sell them to others, avoiding any problems themselves. And if you want to keep up with financial news but don't have time to read it every day, sign up for my free newsletter, Daily Market Briefs, that covers the most important market news that takes under 3 minutes to read. While mortgage bonds undoubtedly helped more people afford homes, this shift towards real estate investing was the catalyst that disconnected housing prices and wages. And today, that disconnect is getting weird. And Wall Street is making it weirder. And by weird, I mean worse. Prior to 2008, real estate investors were mostly regular people, moms and pops who worked for decades and saved just enough to buy a house to rent out to get a taste of the American dream. But it very quickly took on a new path. In 2008, Wall Street's greed screwed up the economy, causing housing prices to plummet and pushing people to sell their homes. In economics, they call this supply and demand. Since millions of people were selling their houses, the supply of houses shot up. Without any new demand, this led to an oversupply of housing, causing prices to fall. It became a feedback loop that led to 4.7 million foreclosures from 2007 to 2011. Looking back, it's clear that this was a pivotal moment for Wall Street and the housing market, a blueprint that laid the foundation for how house prices were about to change forever. It signaled two essential elements. First, there's the US government to think about. With so many people foreclosing on their mortgages, losing their jobs, crashing the economy, the government needed a way to stop the bleeding. In the coming months, they found a savior who could manipulate the markets and economy in ways and in places that no one else could. Ironically, this savior was the same group that caused the 2008 financial crisis in the first place. Hedge funds, banks, and private equity, otherwise known as institutional investors in Wall Street, came in to offer a helping hand. In 2012, the government launched a program that let these groups easily purchase the foreclosed homes by the thousands from Fannie Mae. This personal invitation from the government is what empowered Wall Street to aggressively raise funding to buy as much as possible. They created Real Estate Investment Trust, or REITs, to help out. In finance, a REIT is like a basket of homes, and shares of that basket can be bought and sold, similar to index funds. Soon, money flowed in from around the world. At first, it was tens of millions of dollars, then hundreds, then billions from Qatar, Korean Exchange Bank, shell companies in California, Cayman Islands, and more, just to get in on this investment opportunity. By 2013, institutional investors raised or spent nearly $20 billion to buy single-family homes in the United States. Wall Street's original plan to profit off these homes wasn't terrible. Initially, they wanted to buy the homes, rent them out, and sell them back to the occupants after the economy improved. At least that's what they told Chad Ellingwood and millions like him. Ellingwood was one of millions who lost their houses during the financial crisis who made a deal with a private equity firm. They agreed that after a couple years of renting from them, Ellingwood would take out a loan with them and buy the house back. Except that never happened. When the economy improved, Wall Street realized they could make a lot more money from keeping the houses and renting them out indefinitely. They saw that interest rates were low again, they could borrow money cheaply, become corporate landlords, and charge rents that were more than enough to cover the mortgage payments and still make a profit. And profit they did. More recently, they increased the number of homes they bought and the pace at which they bought them. In the first quarter of 2022, investor purchases of single-family homes averaged 28% per month, which is much higher than the 19% the previous year and is also higher than the average of 16% between 2017 and 2019. We're now in an era where the everyday person and Wall Street, with billions of dollars at their disposal, are bidding for the same exact house, slowly buying up neighborhoods, inflating housing prices, and making housing unaffordable. But institutional investors like Blackstone, the largest owner of single-family homes in the country, are saying it's not their fault. Blackstone claims to have no impact on the housing market because they control less than 1% of it in the US. But is that actually true? At the national level, it probably is true for Blackstone. They and Wall Street most likely don't currently have the pricing power to control the entire housing market, but they are conveniently leaving out one important detail. It's a different story when we zoom in at the local state level: Georgia, Arizona, and North Carolina. A regular person living in Charlotte looking to buy a house doesn't really care about national housing prices. They care more about the prices in their city and neighborhood. 70% of Blackstone's $69 billion real estate portfolio is clustered in the southern and western United States, commonly known as the Sun Belt. Institutional investors intentionally concentrate their purchases in specific markets and neighborhoods so they can impact the market at the local level. In both Phoenix and Atlanta, about 1 in 5 of all single-family homes are owned by institutional investors, as far as we know, because the reality could be much more. When it comes to figuring out who actually owns a property, corporations can easily mask their identity, meaning the number of houses a corporation actually owns could be significantly larger than what they report. In business, they call this the corporate veil. Basically, it's the ability to create a completely new legal entity. Like if I already went to a store and bought 500 Mr. Magic lamps from a store that has a limit of 500 per customer, and then I went the next day to try to buy more, chances are they're gonna say chill and blacklist me. To get around this, I can easily create a new identity or company called Vincent Chan Man LLC and buy more Mr. Magic lamps under that veil. And Blackstone was actually caught doing just this. In 2018, Blackstone expanded internationally and bought homes in Europe. One day in Denmark, tenants started complaining about how poorly they were being treated by their new landlord. They were being harassed for rent, constantly being disrupted with construction projects, and subjected to terrible communication. After some research, the Danes discovered that the new landlord was a small Danish company called 360 North. But behind the layers and layers of corporate veils, it was Blackstone. But are corporate landlords actually that bad? They claim to offer a better experience for the tenants, they say they're more professional, have more streamlined processes, and even has an app to let them into their home without keys. The problem is, corporations exist to make money. They're owned by shareholders, and shareholders expect ever-increasing profits from their investments. The results are rent increases, cost-cutting on building maintenance, and inadequate repairs. In 2017, Colony Starwood, a subsidiary of Blackstone, took over a bunch of houses and did just that. Starwood forced their tenants to use an online payment portal and charged them a $121 convenience fee. Starwood said they sent landscapers to their tenant houses, then charged them $300 for the service, even though the tenants said no one ever came. As a result, in 2016, Starwood made $14 million on fees and an additional $12 million on tenant clawbacks, like keeping security deposits. Then there's American Homes for Rent, one of the largest Wall Street landlords. Between 2014 and 2018, they aggressively charged back tenants, which increased their corporate earnings by 1,000%, even though the number of homes they owned only grew by 70%. Between 2016 and 2018, while rents in the top 30 markets in the country increased by just 6%, American Homes for Rent nearly doubled their rent to 11%. Then there's Waypoint Homes, Equity Residential, Invitation Homes, and thousands more. I've always thought of corporate landlords as the only villains in the housing market story, emerging from their ivory towers with limitless amounts of cash and taking advantage of everyday people. It offered an interesting David and Goliath-esque narrative, but after some research, I'm starting to think that they're just a symptom of a much larger problem rather than the cause. At its core, institutional investors are just chasing an opportunity to make money. And yes, they're contributing to a lot of problems: price gouging, constant rent increases, and terrible service. But there's one other thing that might be the cause of this entire problem. According to Freddie Mac, there aren't enough homes to keep up with the number of new households or families that are forming. The US is about 3.8 million homes short, and experts say the housing market will continue to get worse until the supply of homes improve. With more supply, prices will fall, and Wall Street might not view housing as a profitable investment anymore. The problem is the housing shortage is getting worse every single year thanks to two things. This is a zoning map of a residential suburb in Los Angeles. This is San Jose, California, Arlington, Texas, Sandy Springs, Georgia. The pink areas, which is nearly 90% of these cities, are reserved for single-family homes. The gray areas are for non-residential stuff: stores, shopping centers, restaurants. And these tiny sliver of blue areas are reserved for other residential properties: apartments, condos, and multifamilies. All over the United States, single-family zoning is gospel, loved by homeowners and local governments, rejecting denser housing units, fearing they'll affect home values, and turning towards an "F you, I got mine" mindset. Today, it's illegal to build anything other than single-family homes on 75% of the residential land in many American cities. The problem is, this is exactly how we can balance the housing shortage. But it doesn't seem like anything will change anytime soon. These zoning regulations are backed by NIMBY advocates, which stands for Not in My Backyard. Basically, local residents who oppose developments in their neighborhoods like denser housing units. Whether you agree with them or not, NIMBY groups have gained political influence beyond their own backyard and into entire communities. Groups like Livable California and Resist Density have been responsible for stalling dozens of affordable housing projects around their city, and even sponsoring multiple city councilors into political office. Next, we just don't know how to build homes anymore. After the 2008 Great Recession, the home builders industry collapsed. The revenue of the top 200 home builders dipped 64% in the span of 3 years, leading to nearly 50% of all new home builders to go out of business. Today, while the home builder industry has recovered to almost pre-recession levels, they're facing another problem. Even years after the pandemic and supply chain issues, building supplies are still extremely expensive, and these prices don't even include capital, labor, and import costs. As Wall Street, political groups, and corporations fight over the complex and ever-changing housing market, it's ultimately the everyday Americans, you and me, who ultimately suffer the consequences. But what if I told you that the housing market should be the least of your worries? What most people don't realize is that the American dream is actually dying, and for one of the first times in history, you're more likely to achieve the American dream outside of the US. Click here to learn why and how you can stop it from happening to you.